So I was looking at the charts the other day, going back to late 2025, and I noticed something that looked less like a market and more like, I don't know, a seismograph during a scheduled earthquake.
Scheduled being the operative word there.
Exactly. You look at November, December, January, and there's this pattern. Every single morning, like clockwork, right at 10 a.m. Eastern, the price of Bitcoin would just fall off a table.
And we aren't talking about random noise here. We're talking about a consistent drop of uh, 2 to 3% almost daily. In the world
Wow.
of high-frequency trading, that kind of regularity is, well, it's usually impossible, unless it's engineered.
Right. And that engineer drop is the premise of the massive lawsuit we are unpacking in today's deep dive. We aren't just talking about bad luck or, a crypto winter.
No, not at all.
We are talking about an alleged algorithmic kill switch that wiped out millions in retail positions every single morning, only for the price to magically bounce back 30 minutes later.
It's a fascinating case because it peels back the curtain on market structure. It challenges this whole idea that prices are just the result of buyers and sellers agreeing on value.
Which is what we're all taught, right?
Exactly. But instead, this lawsuit suggests that the game board itself might be tilted.
And the player tilting that board isn't a household name. It's not BlackRock. It's not Coinbase. We are talking about the ghost in the machine of Wall Street, Jane Street.
Jane Street is arguably the most important firm that regular people know absolutely nothing about.
They really fly under the radar.
They do. They are a proprietary trading firm, meaning they trade their own money, not client money. And their footprint is just colossal. I mean, last year, they generated more revenue than the trading desks of Goldman Sachs, Bank of America, and Citi combined.
That is a wild stat, especially when you consider the headcount difference. I mean, Goldman has an absolute army. Jane Street is, what, run by a committee in Manhattan?
Yeah, no CEO, no public shareholders.
And they are estimated to handle something like 10% of all equity trades in the United States.
They are the liquidity. They literally are the market in many ways.
So the mission for this deep dive is to understand the allegations that this specific firm used the financialization of Bitcoin, specifically through the new spot ETFs, to turn a decentralized asset into a rigged casino game.
And to understand how they allegedly did this, we really have to get technical for a second. We have to talk about authorized participants, or APs.
Right. Now, for our listeners who trade, you know that ETFs don't just magically track the price of the underlying asset. There's a whole mechanical process there.
Yeah, an ETF, like BlackRock's IBIT, for example, is just a wrapper. If the price of Bitcoin goes up, the price of the ETF share should go up. But sometimes they drift apart.
They decouple.
Exactly. And an authorized participant's job is to close that gap. They are the only ones allowed to create new shares or redeem old ones. So they buy the actual Bitcoin, give it to BlackRock, get the ETF shares, and sell them to the market to keep the prices perfectly in line.
It's an arbitrage role. They get to capture the spread for keeping the market efficient. And Jane Street is one of only 4 companies on Earth allowed to do this for the major Bitcoin ETFs.
Right. But the lawsuit alleges that they used this privileged position not to fix the market, but to break it.
And this is where we start getting into the K-shaped economy concept, which we'll talk more about later. Because the rules for an authorized participant are fundamentally different than the rules for you or me.
Oh, completely different. They have what the industry essentially calls superpowers, specifically regarding regulation SHO.
Regulation SHO. Okay, so standard refresher for everyone listening. If I want to short a stock, I have to locate the shares, borrow them, and then sell them.
You have to prove you can get them.
Right. If I sell shares I haven't actually borrowed, that's a naked short, and it's generally illegal.
Generally, yes, but APs have an exemption. Because they are required to provide liquidity, to be there to buy or sell when absolutely no one else will, regulators allow them to sell shares they haven't technically located yet.
It's called bona fide market making, right?
Yes.
Yeah.
The idea is basically, hey, I'll sell this to you right now to keep the trade moving, and I'll find the shares in a few minutes to settle up.
It's a grace period. It's meant to grease the wheels of finance. But the allegation here is that Jane Street wasn't using this exemption to facilitate trades. The lawsuit claims they were using it to flood the market with phantom supply.
Precisely. And this leads to the visibility gap. This is the structural advantage that honestly I think is the most damning part of the entire complaint.
Break that down for us.
So, under current U.S. regulations, Jane Street is required to disclose their long positions. If they buy physical Bitcoin to create ETF shares, that goes on a public 13F filing.
Everyone can see it.
The whole public sees it.
So if I'm just an average retail trader looking at the data, I see Jane Street holding billions in Bitcoin. And I'm sitting there thinking, wow, the smart money is incredibly bullish. I should probably buy too.
But that is only half the ledger. They are not required to publicly disclose their short positions, their options, or their derivatives in real time.
That's the gap.
Yeah. So while they are showing you this massive pile of Bitcoin in their right hand, they are completely hiding a massive short bet in their left hand.
The source material used a poker analogy for this, but I actually want to refine it a bit because it's not just that they are hiding their cards. It's like playing poker where Jane Street is allowed to see everyone else's cards face up on the table while they hold theirs under the table. And, oh yeah, they also own the company that makes the table.
That's a very fair assessment of the information asymmetry here. And that exact asymmetry is what supposedly enabled the 10 a.m. kill switch.
Okay, let's break down this mechanism. The lawsuit outlines a highly specific 6-step cycle. Step 1 is the setup. This involved that visible buying we just talked about.
Right. They buy the spot Bitcoin. This serves two purposes. First, it creates the actual inventory they need for the ETF. And second, it signals bullishness to the broader market, which draws in all those retail traders you mentioned.
And then we hit step 2, the hedge.
Which happens entirely in the shadows. They open massive short positions on derivatives exchanges. These are bets that the price will drop.
Right.
And because of those reporting loopholes, nobody sees this immense pressure building up.
Then we hit step 3, which is the dump. And this is the part I really want to pressure test with you. The allegation is that they executed this dump at exactly 10 a.m. Eastern.
Every day.
Right. But my question is, why 10 a.m.? The stock market opens at 9:30. Why wait exactly 30 minutes?
It comes down to liquidity pockets.
Yeah.
At 9:30, the open is incredibly chaotic. Volume is huge. It's actually really hard to move the price significantly without spending an absolute fortune.
Too much noise.
Exactly. But by 10 a.m., that initial morning rush has settled down. And more importantly, European markets are moving toward their close. So liquidity, meaning the number of buyers sitting there on the order book ready to absorb a big sale, thins out.
So the market is structurally fragile at that specific moment.
That's it. It's the path of least resistance. The allegation is that their algorithms identified this specific daily window where a large sell order would have the absolute maximum impact on the price. They dump the Bitcoin, and because the order book is thin, the price just craters. It creates this massive red candle.
Which immediately triggers step 4, the cascade. This is where the retail traders just get totally wrecked.
Because this relies on how modern retail trading actually works. Most people aren't just buying Bitcoin and holding it in cold storage anymore. They are day trading with leverage on platforms like Binance or Bybit.
Right, they're borrowing money to multiply their bets.
And when you use leverage, you have a hard liquidation price. If Bitcoin drops, say, 3%, your position gets automatically sold by the exchange to cover your debt. You don't have a choice.
So Jane Street basically pushes the snowball over the edge of the hill, and gravity does the rest.
Exactly. The initial drop from their dump triggers the first wave of retail stop losses. That forced selling drives the price down even further, which triggers the next wave of liquidations.
It's a chain reaction.
It's a complete cascade of forced selling. Jane Street doesn't actually have to push the price down 5% themselves. They just have to nudge it enough to trigger the exchange algorithms that will drive it down 5% for them.
And meanwhile, they're sitting on those massive short positions from step 2.
Which brings us to step 5, profit taking. At the absolute bottom of that engineered crash, they close out their hidden shorts, booking massive profits.
Which leads right into step 6, the reset.
Yep. They buy back the actual Bitcoin at the new crash price.
And that sudden buying pressure pushes the price right back up.
So by 10:30 or 11 a.m., if you look at the chart, it looks like a perfect V. The price is right back to where it started. The volatility is completely gone. But the retail traders who got liquidated at the bottom,
They're just wiped out.
they are gone. Their money has effectively been legally transferred to the authorized participant.
It's a literal value extraction machine. But here's the thing about financial conspiracies. Usually, they are incredibly hard to prove because you just can't isolate the variables. The market is too messy. But in this case, we have a fascinating before and after scenario.
The smoking gun, as the lawsuit explicitly calls it.
Yeah. On February 23rd, this lawsuit was filed, the allegations went public, and what happened to that daily 10 a.m. drop?
It vanished.
Instantly.
Instantly. The very next day, the pattern just completely stopped.
And what happened to the overall price of Bitcoin?
This is the really telling part. Within 48 hours of that supposed suppression stopping, Bitcoin surged 10%. $200 billion of capital flooded back into the market, and crucially, $213 million in short positions were liquidated.
That implies those short positions were relying on that artificial daily drop to survive. Once the pressure was removed, natural market demand just blew them out of the water.
It strongly suggests that the market price was being artificially suppressed. It's exactly like holding a beach ball underwater. The second you take your hand off, it violently shoots up.
Now, obviously, the defense might argue that markets change and volatility is just random.
Of course.
But the timing, the exact day-to-day correlation with the lawsuit filing is incredibly difficult to just wave away as a coincidence.
It is. And if this were an isolated incident, maybe we might give them the benefit of the doubt. But the deep dive into the source documents shows a pattern of behavior. This isn't Jane Street's first rodeo with international regulators.
No, it is not. And this is where we really have to zoom out to the global stage. We tend to be very U.S.-centric in finance, but Jane Street operates everywhere. In July 2025, so just last year, SEBI, the Securities and Exchange Board of India, cracked down hard on them.
And SEBI does not mess around.
They really don't.
They found Jane Street guilty of a scheme they literally called morning pump, afternoon dump, operating in the Indian options market.
Morning pump, afternoon dump. That sounds incredibly familiar.
It was a very similar high-frequency algorithmic strategy designed to exploit specific market structure vulnerabilities.
And the penalty there wasn't just a fine and a strongly worded letter.
No, SEBI froze $566 million of Jane Street's funds. They effectively locked the doors and said, you aren't taking this money out of the country. They also barred them from the Indian derivatives market entirely.
Wow.
That is a massive validation by a major global regulator of the idea that these types of strategies are not just smart trading. They are actively manipulative.
And there are reports out of China as well, right, regarding silver ETFs.
Same exact playbook, just a different asset class. It paints a picture of a quantitative firm that treats the entire global economy like a video game where they have found a glitch in the code.
Right, whether it's silver in Shanghai, options in Mumbai, or Bitcoin in New York. If the market structure allows for an exploit, the algorithm finds it and hammers it. Now, speaking of exploits, we absolutely have to talk about the Terra Luna connection from the lawsuit, because this is the part of the document that feels like a flashback to a crypto trauma we all lived through.
2022.
Yeah, 2022. The collapse of the Terra ecosystem. $40 billion just evaporated.
Yet the lawsuit actually alleges that Jane Street wasn't just a lucky bystander in that collapse. They allege Jane Street was a catalyst.
Explain how that works.
It revolves around insider information. The claim is that Jane Street had back-channel communications with Terraform Labs.
The people running the stablecoin.
Right, and they allegedly knew that Terraform was quietly pulling $150 million from a liquidity pool on Curve, which is a decentralized exchange, to shore up their own reserves.
And for anyone who remembers that crisis, that specific move made the stablecoin UST incredibly vulnerable to a depegging event. It lost its armor.
Exactly. And the allegation is that, knowing this internal move was happening, Jane Street allegedly executed their largest single withdrawal ever from that ecosystem. They pulled $85 million from that exact same pool.
But it's the timing that really matters here.
Right. Crucially, they did it in a 10-minute window just before the public collapse started.
10 minutes? That is highly suspicious.
It's front-running in its absolute purest form, if true. The argument the lawsuit makes is that by withdrawing that $85 million all at once, they didn't just escape the fire, they sucked the remaining oxygen out of the room.
They caused the fire to spread.
Right. That massive withdrawal accelerated the panic that ultimately destroyed the peg.
So while regular retail investors were being told on Twitter, steady lads, deploying more capital by Duquan.
Which is infamous now.
Right. While that was happening, the smart money was already quietly out the back door.
Exactly. And this brings us to the defense, because we have to report this impartially. We're looking at the sources from both sides.
Right. We're just conveying what the documents say.
And Jane Street has vigorously denied all of these allegations. Regarding Terra, their defense is pretty straightforward. They point out that Duquan was a fraudster. He pleaded guilty. He is literally in prison.
So their argument is essentially, don't blame us for the collapse of a Ponzi scheme that was doomed to fail anyway.
Precisely. They argue that they are simply managing their own risk. If their algorithms or analysts saw a collapse coming, they had a fiduciary duty to get their capital out.
Just because they were faster than everyone else doesn't make it illegal.
Right. It just makes them better, faster traders.
Which, honestly, is the classic Wall Street defense. We aren't cheating, we're just smarter and faster than you.
And legally speaking, that might actually hold up in court. Proving intent to manipulate is notoriously incredibly difficult in the U.S. legal system.
Because you have to prove they intended to crash the price, not just that they sold at a highly opportunistic time.
Exactly. The burden of proof is very high.
But regardless of the actual legal outcome of this specific suit, the philosophical implications here for everyday investors are just heavy. We talk about the caged asset theory in our research notes.
I think this is the single biggest takeaway for you, the listener. You have to remember, Bitcoin was originally created to be the anti-Wall Street asset.
Right, post-2008 financial crisis.
It was designed to be peer-to-peer, trustless, no middlemen, no intermediaries, a life raft outside the traditional system.
And now?
Now, by wrapping it in these spot ETFs, we have effectively caged it. We've put the life raft inside the sinking ship. We put it inside the exact existing financial infrastructure it was meant to escape.
So now the actual price of Bitcoin isn't really being discovered organically on the blockchain.
No, price discovery has moved to exotic markets. It's being discovered in the derivative order books of authorized participants who have Reg SHO exemptions and high-frequency algorithms.
We basically invited the fox into the henhouse because everybody wanted the fox's money.
Everyone cheered for institutional adoption. Well, this is exactly what institutional adoption looks like. It means the asset is now subject to the exact same structural games as GameStop or Tesla or silver.
And this circles all the way back to that K-shaped economy idea we mentioned at the start. You have these two completely diverging paths in modern finance.
You have the smart money, the Jane Streets of the world, who operate entirely on the upper branch of that K. They have the AP status, they have the regulatory exemptions, they have the microscopic visibility into the order flow, and they have the speed. Their entire business model is extracting value from inefficiencies.
And on the lower branch of the K, you have the average learner, the retail trader sitting at home. They are looking at technical charts that are arguably a complete fiction, trading with leverage they don't fully understand against an opponent who can literally see their cards.
And that's exactly why these deep dives matter so much.
Yeah.
You can't just look at the price ticker on your screen. You have to look at the plumbing behind the screen. If you don't understand how the pipes work, you're going to get wet.
So let's wrap this up with a final thought to mull over. We have a massive lawsuit, we have a firm denial, and we have a global market that suddenly started behaving very differently on February 24th.
That change in market behavior is really the key thing to watch going forward. If the 10 a.m. dip stays gone permanently, it strongly validates the theory that it was an artificial construct to begin with.
And it leaves us with a really provocative question for you to explore on your own. If the fundamental structure of the market, these AP loopholes, the reporting visibility gaps, if that structure allows this to happen legally, or at least in a very murky legal gray area.
How many other Jane Streets are out there right now?
Exactly. Jane Street is just the one we happen to be talking about today because they got sued.
Right. They caught the spotlight.
Are we just seeing a temporary glitch in the matrix, or is this literally just how the matrix is designed to run?
I think anyone who looks closely at the plumbing knows the answer to that.
So learn the system before you play the game, especially with debt. Stay curious, stay skeptical, and maybe don't use 100x leverage on a Tuesday morning. Thanks for joining us for this deep dive.
See you next time.